938 Live. This is Talkback.
Has Singapore fallen out of love in investing in stocks? Do you want more predictable returns on your money than you can get from investing in shares on the Singapore Exchange? Or do you think that trading activity on the SGX is currently so limited that the chances of making strong gains is simply too remote? And with everyone having increasingly busy lives, do you even have the time to closely monitor shares and make decisions about the best time to buy or sell? And if you're not trading shares, where are you parking your investment capital? What are the best alternatives? A whole lot of questions for you. You can call us on 669-11938 and share with us if you will remain in the Singapore market. Now, on Wednesday, Southeast Asia's largest bourse, the SGX, suffered a third major trading interruption this year. In fact, it's second within the month. The market opened 3.5 hours late because of a software error that didn't allow brokers to reconcile their clients' trading positions. Now, the Monetary Authority of Singapore came down hard on the SGX, expressing its disappointment and concerns. And the regulator said the lapses are unacceptable, coming within weeks of the recent power breakdown on November 5th, which halted the trading of the securities and derivatives for more than 3 hours. Earlier in April, in fact, trading on SGX's derivatives market was suspended for close to 3 hours following a computer hardware breakdown. Now, these glitches have come during a year when share trading volume on the SGX has been falling. And according to Bloomberg, the daily value of stocks traded in Singapore averaged 1.05 billion this year, but that's a 25% drop from 2013. So some people have pointed the finger of blame for the low trading volume on last year's penny stock debacle, which wiped 6.9 billion off the market value of 3 commodity companies over 3 days in October 2013. And then now, of course, we have these technical glitches. They may be creating further doubt in the minds of some investors about whether investing in shares is the right option for them. So what's going on? What do you think are the key reasons for the lackluster share market in Singapore? Joining us in the studio today is David Kuo. He is CEO of Motley Singapore. David, thanks for joining us.
Good morning, Andre.
Now, Dave, what is going on? I mean, why is share trading in Singapore currently so lukewarm?
Well, there are all kinds of reasons for that. You know, first of all, I mean, there might be some, as far as investors are concerned, I mean, there might be some concerns about whether or not the market is overvalued right now. In other words, are they paying too much for the shares? And so some of them are sitting on their hands a little. Then, of course, you know, you have people who don't really understand volatility a great deal. And they're saying that, oh, you know, if I put my money into the stock market, I could lose my money. And so therefore, why don't I just sort of take my money and go and put it somewhere else, like in a savings account? But, I mean, as far as I'm concerned, I am not buying shares. I am not trading. I am investing in companies.
Right.
And that is an old-fashioned way of looking at the stock market. If I see a company like DBS Bank or UOB or OCBC, any of these companies, I'm saying, is this a good time to buy a share in this in this company, in this organization? And if I think it is, I will go in and I will buy those shares. And, you know, you mentioned earlier on about, you know, when is a good time to buy, when is a good time to sell. And as far as I'm concerned, now is always a good time to buy and never is a good time to sell.
Okay.
Yeah.
I just wanted to ask you, though, you mentioned, do you think the market is overvalued?
I don't, as a matter of fact, you know, because one of the quickest way of seeing whether or not a market is overvalued or undervalued is this thing called the PE ratio. And the PE ratio is just simply how much are you paying for a $1 of profits that Singapore companies are making. And currently it works out at around sort of $13 or $14 Singapore dollars that you are paying for every dollar of profit that companies make. Now that is not expensive at all. What you are actually sort of saying is that if you were to pay out $13 for the whole of the Singapore market, you would be getting $1 of profit on all the companies that make up the Singapore Exchange, that make up the Singapore market. And that is not expensive at all. In order to get $1 of profit from an investment in the bank, you would have to pay somewhere in the region of 50 Singapore dollars to get $1 of interest.
Right.
But in this particular case, you're only paying 13 for every dollar of profit that Singapore companies make. So I would say it's not particularly expensive right now.
Okay. Well, 669-11938, we have Edward on the line. Hi, Edward. Edward? Hello? Edward, can you hear us?
Hi, good morning.
Good morning.
Andre, hi,
Yes.
good morning.
What are your
Hello?
thoughts? Yes, I can hear you, Edward.
Yeah, can you hear me?
Loud and clear.
All right. Good morning, gentlemen. Yes. Good morning. Yeah, I just feel that the recent technical glitch is quite embarrassing.
Edward, I think you need to turn down your radio.
Yes. Can you hear me better now?
Yeah, we hear you loud and clear now.
Sorry. Yeah.
Okay.
The glitches is really quite embarrassing. I think for the short term, people will stay on the sideline, but overall, after some time, they will still come back. But I think something needs to be done. I think they need to actually bring back the confidence of the investors again.
Okay,
retailers like us, we probably will forget after a while. But I think it's the institutional buyer that may actually, because there's so many other markets that they can go into, so they might stay away for a while. So I really hope that the SGX do something about it.
So,
because it's going to be like the MRT thing, keep breaking down, and then people just get fed up.
Sure. So are you holding positions now in the market, or I take it you are holding positions?
Yeah, I'm holding. I'm waiting to buy again, so I just wait and see.
Okay. How do you think more excitement can be put into the market here?
I think I'll leave this to the experts to come out with all these plans to contingency plans to prevent similar kind of breakdowns again.
Okay. All right. But thank you very much for calling, Edward, and expressing
Thank you. Have a good day.
Thanks,
Yeah.
you too.
Bye.
So, Dave, Edward was...
Did I hear you right? Did you say you want more excitement in the market? I mean, that's the last thing I want in the market.
Really?
I don't want any excitement at all. I mean, I want the companies that I invest in to carry on doing what they're doing in a quiet sort of way. The last thing, I want to be able to sleep at night. I don't want excitement. I want to know that, when I buy shares in any company, if I buy shares in a REIT or if I buy shares in a manufacturer, that it's going to take my money and it's going to invest that money properly and it's going to generate a return for me.
Right.
If it does it very slowly, that's great. I don't really want any volatility in the market.
Oh, not volatility, but, maybe...
I don't want excitement, thank you very much. Not at my stage in my life.
Okay, but Edward did mention something. He said maybe the institutional investors could, I don't know, inject more interest or, better products. I'm not sure.
Okay.
What do you think?
Well, there are all kinds of things here. The institutional investors are always looking for value for money. So I don't know if you are a supermarket shopper at all, Andre. Do you do it?
Certainly, of course.
You do supermarket shopping.
Sure.
Okay. So let me give you an example, right? You have a choice of supermarkets that you can go to. You can go to Cold Storage. You can go to Jason's. You can go to Sing Siong. You can go anywhere you want.
Right.
You can go to Tekka Market. So you are going to go somewhere that is convenient. You're also going to go somewhere that is going to offer you value for money. Now, if you think that you want to buy a piece of chicken and it's quite expensive at one supermarket but cheaper at another one, you're going to go to the cheaper one.
Sure.
So as far as institutional investors are concerned, they are looking at the global market, and the caller was absolutely right. They look at the global market and they say, where can I put my money that is going to give me my best possible returns? And they will say, at the moment, the Singapore market is not looking expensive. If you compare the Singapore market with the American market or the UK market or even the Chinese market, you would say those are looking a little expensive now. So therefore, I think I will put my money in Singapore. So money can go anywhere you want to.
Right, okay. Yeah. 669-1193, we've got Andy on the line. Hi, Andy.
Hi, good morning.
Hi, good morning. What are you thinking about?
Well, I see the MAS came very hard on SGX and the public reacted. Personally, I think that it's no big deal. I think it's the first time that happened to us that, we break down, we delay in trading. Just look at Hong Kong or Tokyo. They always delay trading because of weather. Typhoon, black rain, yellow rain, red rain. And, it's part of life. I think SGS has to fix the problem and move on.
Okay.
And I don't think it's no big deal. I mean, looking about we delay for half a day. I mean, we don't face the problem of typhoon, but the other markets do.
Right.
And what is the big issue? That's my point.
Okay, but some say, because of the delay, opportunities were lost from the American and the Chinese markets. Do you agree with that?
Well, I think it's exaggerating. How much do you lose? How much do you fail to make because you can't buy? Is it a delay of trading will make the price different? No. There are days when we have a public holiday. The day before, there was a surge in Wall Street, and we didn't benefit, we didn't react, but we reacted the following day. Likewise, when New York collapsed and we have a holiday, and when we open our trading a day later, the market will go down. So right. I think it's just basically one of the excuses that people try to be experts, try to think that, make all sorts of comments. I think personally, there's no big deal.
Okay. Well, thank you very much for that, Andy. And thanks for sharing us here on 669-11938. We still want to take your calls. Do you agree with what Andy just said, Dave?
I do agree. You see, it would be wrong if, for instance, some people were allowed to trade and other people were not. But in this particular case, nobody was allowed to trade. And I looked at the market, and as soon as it opened at 12:30, the stock market started rising. So, I mean, if a rising stock market is an indication of confidence, then you would say that, people haven't really sort of haven't really sort of considered the glitch, that happened in the Singapore market as being a big deal. Yes, it should not have happened. Yeah, that is absolutely right. Is it avoidable? Perhaps it was avoidable. But my experience with computers is that if anything can go wrong, it will go wrong.
It will go wrong.
Yeah.
Newton's law. Thanks for joining us here on Talkback on 938 Live. And, we are asking of you whether Singapore has fallen out of love in investing in stocks, and whether also the glitches in the SGX have been a put-off for you. 669-11938 is the number. We had Edward and Andy calling in. Andy didn't think too much about the glitches. It doesn't bother him so much. He says it's all part and parcel of the market and what it should be. Edward said, he's hoping that the institutional investors will lead a little bit more in the market. Tell us what you think. 669-11938. In the studio with us is David Kuo. He is CEO of the Motley Singapore. David, now, to what extent has sentiment toward investing in shares, especially among the retail investors, turned sour that you think it might be hard to reverse this particular trend, you think?
There are several issues here. I mean, the first one is sentiment itself. As far as investors are concerned, they can put their money anywhere. I have this rule that there are only 4 asset classes. In other words, there are only 4 places that you can put your money. You can either put it in a savings account, you can buy bonds with it if you want, or you can put it in property, or you can put it in the stock market. Right? There are really only 4 places that you can actually put your money. Right. It will generate a real return for you. Some people might say, what about gold? Yeah, I can put it in gold. Yeah, I thought you might. Yeah. Yeah.
Well, I mean, the market has introduced trading in gold.
Yeah. Well, the whole thing about gold is that it doesn't really do a great deal. I know a lot of people like gold because
they sit there and glitter.
Well, apart from sitting there in glitter, but some people might say, gold is a very safe investment. I can see it, I can touch it, I can feel it. But the thing about gold is, if I were to give you an ounce of gold, not that I'm going to, Andre, but if I were to give you an ounce of gold, if I were to give you an ounce of gold now, in 10 years' time, you still only have an ounce of gold.
That's correct.
In 20 years' time, you still only have an ounce of gold, right? And the price of that ounce of gold will go up and down. It'll be like you jumping on a pogo stick. It can go up, it can go down. You have no control over what the value of that is.
Sure.
If more people want to buy it, then the price will go up. If fewer people want to buy it, then the price will go down. And that is the only thing that you have. Whereas if I were to take the money that I were to put into that ounce of gold and I buy shares in a company that pays me a dividend, that pays me a share of the profits that they make,
right,
then in 10 years' time, if the company does well, I can be pretty sure that share is going to be worth more in 10 years' time than today. So you have a choice. You can either buy something you have no idea what the value will be, or you can buy something that will appreciate in value over time. And I would take the latter any day.
Right. Okay, but of course, when you're talking about shares, you would most probably be referring to blue chips.
Of course, yeah. But not necessarily. I mean, there
penny stocks?
Some people might like penny stocks, but I have this rule about investing. I like to build a portfolio that's got a very sound foundation, and that foundation is generally made up of blue chip stocks. And these are the STI 30 companies, and also other companies that may not be in the STI, but they are primarily very big companies. And as long as I know I have a good foundation, it's like having a good mattress to sleep on. You are going to sleep well at night.
I like that.
And that is very important. You need a good foundation. correction. And then you can, on top of that, layer a little bit of excitement if you want. And if you really want some great excitement, then you can actually have a small part of your portfolio in these penny stocks. But the whole point is, a lot of people get the whole portfolio the wrong way round. They have too much of these very exciting penny stocks, and they don't have enough of the blue chips.
Right.
And that is when problems start to arise, because the penny stocks can be very volatile, whereas the blue chips are generally very stable, and they pay you a dividend over time. And people forget that just if a company can pay you a dividend over a long period of time, it will increase your wealth over that period. Yeah, over that period of time.
Now, the thing is, the trading volume in the SGX has fallen.
Yeah.
But so what's your sense of where people might be placing their investment funds? Where are they putting that?
Well, there are all kinds of things here. And one of the big obstacles in the Singapore market, and I came back to Singapore about 2 years ago, having been in London and working for the same company in the London office. Mm-hmm. And when I came back to Singapore, I hadn't realized that you didn't move with the times. In most other markets around the world, people can buy as little as one share, right? You can actually say, I want to buy one share in Jardine Cycle and Carriage. I want to buy one share in Keppel Corporation if I want to. Obviously, you got to work out all the charges and all that and whether it's viable to do so.
For sure.
But if I wanted to, I could buy one. Here in Singapore, they said you had to buy 1,000.
Yeah.
I went, you got to be kidding.
Okay, but okay, let me hold you there. So, but the SGX has finally announced that come 19th January, that is going to change. The standard board lot size from 1,000 is going to go down to 100 units.
Correct. And that is going to make a big difference to private investors. I mean, to investors like you and I. Whereas previously, if we wanted to buy, say, shares in DBS Bank, I mean, we would have to fork out somewhere in the region of 20,000 Singapore dollars to buy one lot.
Yeah.
Now they'll be cutting the lot size on the 19th of January 2015.
Right.
And that'll be cut to 100, which means that one lot of DBS shares could cost you roughly around 2,000 Singapore dollars.
Which is affordable.
Which is absolutely right. It suddenly...
Right.
And that'll be cut to 100, which means that one lot of DBS shares could cost you roughly around 2,000 Singapore dollars.
Which is affordable.
Which is absolutely right. It suddenly becomes affordable. So it'll open up the market to lots of people. Not many people have the ability to buy one lot of DBS shares. And investing shouldn't really be kept to the elite. It should be given to an opportunity for everybody to invest. So you should be able to take your CPF money and say, I want to buy one lot of this, I want to buy one lot of that. And one lot in that case will only be about 100 shares.
Yeah.
And you can start building your portfolio. You can start building that mattress of good quality shares.
Why on earth are we taking so long?
Well, there are all kinds of reasons for that, and I do not know the ins and outs as to why it has taken so long. But I'm just grateful that a lot more people will be able to afford shares, and they will be able to build that mattress that I talked about. Rather, you see, one of the big problems when I first came to Singapore was that people were looking on the price column. They were looking and saying, I have 2,000 Singapore dollars to invest. What shares can I buy for less than 2 Singapore dollars, right? Rather than to say, is this a good company to invest in? And then say, I want to buy 100 shares of those. They couldn't do that. If you wanted to buy DBS, you couldn't do it if you only had a couple of thousand Singapore dollars.
Correct.
You needed at least 20,000. And if your entire investment is only 20,000, you've got to put everything into one company. I mean, that doesn't make sense either.
So do you think now with this happening next year, you think activity will go up and volumes go up as well?
I am almost certain that it will go up, simply because there is a lot of pent-up demand out there for people who want to buy these blue-chip shares.
Right.
And it'll be the biggest change in your lifetime, Andre. It'll be the biggest change in Melissa's lifetime. It'll be the biggest change in my lifetime, when we can actually say, I want to buy blue-chip shares. Finally, I can afford it.
Yeah. All right. Well, so that's good news. Moving ahead for the Singapore stock market next year, you have to wait till January 19th, of course.
Not long to go.
Certainly not long. So enjoy Christmas and the New Year's and all that, and then we'll see how it goes money-wise, okay. Right? Thank you very much, David Kwok. He's CEO of Motley Fool Singapore, and thank you very much for your calls as well. You can still talk to us on our Facebook page, Official 938 Live.